Have you ever closed a trade and immediately felt that gut-wrenching regret? Maybe you felt an overwhelming urge to jump back in and fix it, or perhaps an exhilarating rush after a big win that made you feel invincible. These powerful feelings are incredibly common in trading. In fact, emotional trading is something that plagues almost every single person who attempts to navigate the markets. It's a universal challenge. At its core, emotional trading is when your feelings, things like fear, greed, excitement, or frustration, take the driver's seat and control your trading decisions. This leads you down a path of irrational actions, often against your better judgment. Let's be clear, emotional trading isn't just a minor inconvenience. It is arguably the silent killer of trading accounts. It erodes capital slowly, often without the trader even fully realizing what's happening until it's too late. When emotions are running high, they cloud your judgment. They make it incredibly difficult, if not impossible, to stick to your carefully crafted trading plan or adhere to essential risk management rules. Logic goes out the window. The consequences are predictable and painful. You might make impulsive buys or sells, chase losses trying to break even quickly, overtrade out of boredom or impatience, hold on to losing positions for far too long, hoping for a miracle, or cut winning trades short out of fear of giving back profits. The first crucial step in overcoming emotional trading is learning to recognize what triggers these feelings in you personally. Awareness is power in this context. Once you know your triggers, you can start to manage them proactively. One of the most common triggers is FOMO, the fear of missing out. You see a market moving fast, everyone else seems to be making money, and you jump in without doing your research or checking if it fits your plan. That's FOMO driving your decision. Another powerful trigger is revenge trading. You just took a loss, and the immediate, overwhelming feeling is the need to get that money back right now. This leads to impulsive, poorly planned trades aimed solely at recouping losses, often digging a deeper hole. Overtrading is also a significant trigger and trap. This is the constant need to be in the market, to be doing something. It stems from impatience or the desire for constant action, leading to excessive trades that increase both risk and transaction costs unnecessarily. Then there are the two fundamental emotions, fear and greed. Fear often triggers selling too early, causing you to miss out on potential profits because you're scared the market will turn against you. Greed, on the other hand, triggers holding on to trades for too long, hoping for unrealistic gains, often leading to winners turning into losers. Beyond the specific triggers, there are common emotional traps that traders fall into repeatedly. These are patterns of behavior driven by feelings rather than logic, and they are incredibly destructive to profitability. Understanding these traps helps you spot them before you fall in. Let's look at some of the most prevalent emotional traps that ensnare traders, regardless of experience level. These are pitfalls that have cost traders countless amounts of capital over the years. Trap number one is chasing the market. This is purely reactive trading. You see a price moving up sharply, and you buy because you feel like you're missing the rally. You see a price dropping fast, and you sell in panic. You're reacting to price movements based on emotion, not executing a plan, which often results in buying high and selling low. The opposite of profitable trading. Trap number two is ignoring stop losses. This is fueled by hope and denial. You're in a losing position, and instead of exiting at your predetermined stop loss level, you hold on, hoping the market will turn around. This emotional attachment to a losing trade prevents you from cutting your losses short, allowing small losses to balloon into devastating ones. Trap number three is overleveraging. This trap is primarily fueled by greed and the desire for quick, massive profits. You use excessive leverage, risking a disproportionately large amount of capital relative to your account size on a single trade. While leverage can amplify gains, it equally amplifies losses, and emotional overleveraging can wipe out an account in a single trade. The fundamental solution to overcoming emotional trading is not to try and eliminate your emotions entirely. That's impossible. The key is to shift from emotional trading to structured trading. This is where discipline and process take precedence over feelings. Structured trading means you operate from a place of preparation and adherence. It involves having a clear, well-defined trading plan before you enter any trade, and then possessing the discipline to stick to that plan no matter how you feel in the moment. In structured trading, decisions are based on objective analysis, predefined rules and probabilities, not on fleeting feelings or impulses. It's about focusing on discipline, clearly defining your risk before entering a trade, and setting realistic profit targets based on your analysis. Now, let's talk about actionable steps. What can you actually do starting today to reduce the impact of emotional trading on your results? Here are 5 practical fixes that successful traders use to manage their emotions and stick to their plans. Fix number 1, develop a trading plan. This is non-negotiable. Write down your entry criteria, your exit strategy, your risk rules, how much you'll risk per trade, and your profit targets. Having a written plan removes ambiguity and gives you a roadmap to follow when emotions flare up. Fix number 2, use stop-loss orders. This is your primary defense mechanism. Implement stop-loss orders on every single trade. This automatically exits you from a losing position if the market moves against you by a predetermined amount, protecting your capital and preventing you from holding on to losers out of hope or fear. Fix number 3, journal your trades. Keep a detailed record of every trade you make. Note the entry, exit, profit, TAKIO, loss, and importantly, how you were feeling before, during, and after the trade. Analyzing your journal helps you identify patterns in your emotional responses and see which feelings lead to poor decisions. Fix number 4, practice risk management. This is about position sizing. Risk only a small, fixed percentage of your total trading capital on any single trade, typically 1 to 2%. This ensures that no single loss, even if it hits your stop loss, can significantly damage your account, reducing the emotional impact of losing trades. Fix number 5, take breaks. When you feel overwhelmed, frustrated, or overly excited, step away from the charts. Even a short break, 15 minutes, an hour, or even a day, can help you clear your head, regain perspective, and prevent you from making impulsive decisions driven by intense emotions. Let's be real for a moment. Experiencing emotions while trading is completely normal. You are human, and trading involves real money and real potential for gain or loss. It's natural to feel something. The goal here is not to become a trading robot devoid of all feeling. That's an unrealistic expectation. The true goal is to acknowledge your emotions, understand their potential impact, and develop strategies to manage them effectively so they do not dictate your trading decisions. It's about control, not elimination. So let's talk about your experience. In the comments section below, share what emotion affects your trading the most. Is it fear, greed, frustration, or something else? Sharing helps build a community and reminds us we're not alone in this struggle. If you found this video helpful and you're serious about improving your trading psychology, please give this video a like. It helps us reach more traders who might be struggling with these same issues. And if you haven't already, subscribe to the channel for more insights and strategies on becoming a more disciplined and profitable trader. Don't forget to hit that notification bell so you don't miss future videos. Remember, mastering emotional trading is a journey, not a destination. It takes time, self-awareness, and consistent effort. Keep learning, keep practicing your discipline, and keep trading smart based on your plan, not your feelings.